You gotta be flipping my flapjacks. Yesterday on X, I posted this. I said, I'll just leave this here. Trump is the king of setting bear traps. That was yesterday afternoon, and what happened today? Oh boy, public count up over $100,000 here today, ladies and gentlemen. So we have a fascinating market. We have a flippening in regards to many matters that were concerning to folks and have magically flipped, right? So we're going to talk about what this means for the market moving forward. We're going to talk about a lot of stocks in this video here today. So if you love stock talk, you're going to definitely love this one here today. We're going to talk about what stocks are positioned best for the movement this market is now on at this point in time. So we're going to get into a lot of that in this video. From there, we're going to talk about Tom Lee. Tom Lee went on CNBC about an hour ago, spoke about his opinion on the market, everybody's fearless leader, Tom Lee. So looking forward to reacting to what he had to say. Then I want to react to this one. Steve Weiss sells half his Netflix position. Big decision to make there. Selling half your Netflix stock on a down day like it is today when the stock's already down big. So we'll talk about my perspective and opinion, not only on Netflix, but like selling a stock that's a great company when it's down significantly. And if I agree with doing something like that, okay? So I just want to jump straight into this, guys. I appreciate you for joining me. All I need from you is just smash that little like button. That's all I ask, okay? If you could do that for me, it means the world. Additionally, if you want to be subscribed to the channel, you can certainly subscribe. Pinned comment down there today is if you're looking to apply to join my private stock group, private wealth group, 1000xstocks.com. You want to take your knowledge up to a much higher level, join a group of individuals that are, let's call it very sophisticated group. That will be the pinned comment down there. That is specifically for folks that have $100,000 plus net worth. Okay. If you have less than $100,000 plus net worth, my Patreon is probably a better fit for you. So that's always linked in the description area down there. But if you have over $100,000 net worth, you're a better fit for the private group with us. Okay. Alrighty. So here's the deal. Okay. Listen. This does not come as a surprise to me. If you watched last night's video, right, I spoke about bear traps. I said, don't be surprised at all if this is a bear trap being set, right, where people are getting real concerned, like market just might go down and, and suddenly, boom, pops right back, right, and public count up $100,000 today. So that is what it is, right? Now, with that being said, what stocks kind of position best if we're going to move back into a market where folks want to take risk, which is what you can do. You got to understand, we were in a very hot stock market there for a while, right? When I say a while, I'm really talking about we were in a very hot stock market from basically the beginning of the fourth quarter of 2022 into the beginning of the fourth quarter of 2025, right? So we were in just, flying. Ever since the beginning of the fourth quarter, it's been a little shaky, right? We had some drama in the fourth quarter. Then we had a Santa Claus rally. Then we had a chilling of the market. So ultimately, the market's just been grinding, not doing a dang thing. As of yesterday, the NASDAQ was down about 5% from its all-time highs. So, just kind of like a little bit of a down market, but not down that much. Everything just kind of like asleep. And we have a potential where we could go back into a bull cycle. And you got to understand, when you went through a long bull cycle, you're going to have a period of either consolidation or maybe a slight downtrend, and then like another bull cycle ahead of that. Sometimes you can get a crash, right? If you have like a black swan event, something like that, that can end the bull market. Other than that, you might just have like a consolidation period, something where the market maybe goes down 5-10% and then starts a new bull market, where that next bull market is usually shorter than the first one. So do I think we go back into a 3-year bull market? Probably not. But could we go into a strong 6 to 18-month bull market? That's very possible, okay? And obviously, you never want to bank on these things like, I'm going to go all in call options because the market might skyrocket for the next 6 months or 12 months or something like that, right? Always stay focused on the next 3, 5, 7 years and not just the next 3, 5, 7 weeks or months, right? But don't be surprised if we can go back into a bull run. Now, if we do that, what stocks position very well for that sort of environment, right? Well, first off, a stock right off the bat that's clear as day is AMD, right? AMD is an absolute beast right now. This is over the last 5-day period. It's up about 15%. Now, it's very impressive. Why? Not just because it's up 15% roughly in the past 5 trading days, but if you look at it versus NVIDIA, if NVIDIA was rolling and it's just all semiconductor stocks are just skyrocketing, it's not as impressive. It's like, there's just a big movement in that space. But the fact that NVIDIA is flat flat for the past 5 trading days, and yet AMD's up about 15%. That's a very bullish signal for AMD stock overall, right? Now, AMD could easily continue to run heavy as long as we have a slight bullish market for the next, let's just call it between now and summer, okay? If we have a slight bullish market, AMD could easily continue to rally, and that stock could push 325, could push 350, okay? If we have a big bull run, where let's say this market actually goes very risk on for the from now till summer, I mean, look out. It wouldn't be out of the realm for AMD to push 350, 400 if we had a big bull run. And the reason being is you got to understand the middle of this year, that's when 450 goes into production. There's just so much hype and excitement about what that's going to do for numbers. And as you get closer, the hype builds and builds and builds, right? When that moment comes, AMD could actually take a breather. And that's going to mess with people's minds big time in regards to this. Because you could have, once again, if we go totally risk off in the market, AMD could actually still keep going up because it has that much momentum, but it's going to get much tougher. But if you get into a slight bull market, especially if you get in a big bull run between now and summer, AMD could push heavy. It could shock people. Like, if you want to look at a stock to show proof of like how much momentum can really come into these stocks at a particular time, I'll show you a stock. It's not a stock I personally own. A good friend of mine, shout out to him. He has a significant position in this stock. He's had it for years. But look no different than a stock named Micron. Micron's had about the same 5-day performance as AMD, but check this one out on a 6-month. You ready to have your flapjacks flipped? Look at this. 236% gain in the past 6 months. AMD is up a shocking 57% in the past 6 months, which is amazing performance. Like, if you can get 57% in 6 months, oh my gosh, legendary. MU's at a whole different level. 236%. This stock just sees more momentum. And so that's why I say with a stock like AMD, you get into a slight bullish market here, given we're getting into 450 production, as the numbers come out, as guidance comes out, as more and more people get hyped about 450 series and then 500 series in like a year or two from now. Woo-wee! Like, the momentum in these semiconductor stocks, when it's going well, it can go very well. It can be shockingly well. Keep in mind, on the downside, it's brutal, right? AMD will have a brutal day someday. And when I say a brutal day, I mean like a brutal year. That's not right now. Not with 450 going into production middle of this year and then the 500 series. AMD is going to have several years ahead of just absolutely knocking the doors off. But at some point in time, AMD is going to have a tough run at it. Same thing with MU. MU is going to get brutalized at some point in time. It's not right now because memory pricing continues to go higher, and the demand for memory is just ridiculous right now for high bandwidth memory specifically, right? And so AMD will have eventually a tough time. MU will eventually have a tough time, right? But it's not right now. It's not right now. Right now is party time. And in terms of AMD, it's going to be party time for a bit. And if you could get into a bull market here, we could have another bull run with, oh gosh, AMD the run. I mean, I have a lot invested in AMD stock, right? And today I was looking at one of my portfolios and I was like, maybe cash just a little bit of shares. I was thinking like maybe just cash like 30,000, 50,000, because it has been a significant run from where I got in at AMD. Like, it's been a fun run. I mean, the fact this stock's basically 250 now is like, and I looked at it and I'm like, dude, it's not yet. Not yet. There will be a day when it makes sense to start cashing AMD, but for me, it just does not make sense right now. Not with the chips that are coming over this next couple of years here, right? And not with the demand that AMD is going to have for the next couple of years here. And when I say couple of years, it's going to be longer than a couple of years. It's just the next couple of years are going to be the insane growth, right? They're going to still continue to grow the business for a long time to go in the future. Like, between now and 2030, it's AMD's time to shine, right? And the market recognizes this. That's why AMD's so significantly outperforming NVIDIA, which is what I talked about, right? And I also talked about in 2026, this year, we're going to have a major event happen between AMD and NVIDIA, right? What have I told you guys is going to happen? I called this out. And watch, it's going to come true. Just as I predicted, AMD was going to start outperforming significantly NVIDIA stock price, right? Which is what has happened. Look at, since the April lows, like look at AMD versus NVIDIA. AMD's at a whole different stratosphere versus NVIDIA, right? The next thing that's going to happen, I've been talking about this, it's going to happen here in 2026. It's going to be big. You know what it is? AMD's revenue growth percentage is going to start to outstrip NVIDIA, and that's going to happen this year. It's going to be a huge flip that happens, which is going to bring even more attention to AMD, because then people are going to be looking at AMD and it's like, it's not just hype, it's not just hope, it's wow, AMD's actually growing at a faster percentage clip than NVIDIA, right? And once again, as I've told you guys a million times, this doesn't mean NVIDIA is a bad company. NVIDIA is amazing. They're going to continue to do amazing, right? And put up amazing numbers. It's just they got out in front of everybody. They put up their crazy numbers already. Now they're just going to put up very solid numbers, basically moving forward, right? AMD is now at the moment where they're putting up those huge numbers, those ones that are going to knock people's socks off. And whoa, AMD just grew how much in the quarter? And they're going to look versus NVIDIA and they're like, why would I buy NVIDIA when AMD has the major growth, right? So that's what we have going on, and that's why AMD continues to see so much momentum versus a stock like NVIDIA, right? And to kind of show you guys and illustrate this point, look at from the April lows where these stocks are, kind of positioned at. NVIDIA's done very well from those April lows, up 90%. But look at AMD. It's well over a double up, 219%, right? MU's got them all dusted right now, though. MU's just on a whole different stratosphere, right? 493% gain for MU. Let me be clear, though. MU, riskiest of these three stocks by a large margin. And the reason being is MU's business is commoditized. In a commoditized business model, when you're going through a super cycle of demand, it is unbelievably great, right? Unbelievably great. And that's what we're going through right now. But as soon as the supply and demand get more on equal levels, pricing starts to come down, right? And you can't go up on pricing anymore. Then if demand gets hit at all, that's when it gets rough for you, right? And so just keep in mind, it's a super party right now for MU, but that one will get hit the hardest of everybody. Like when these stocks have their tough time, which it will be at some point in time, but it's just not anytime soon, right? But when that time period comes, just understand MU will have significantly more downside than NVIDIA does and than AMD does. So just keep that in mind and watch. It'll all play out. Once again, to predict exactly when those stocks start to falter is difficult. It could be a year from now, it could be a year and a half, could be 2 years out, could be 3 years out. But when that day does, and it will come, as an AMD shareholder and person that's got a massive amount of money invested in the stock, that day will come. It's just not today, but it will come. And when all those stocks fall, MU will fall the hardest, by far. So if and when we ever get to that time period when I think the semiconductor stocks are going to be in trouble, right? I would look to hedge against MU versus hedge against AMD and NVIDIA, right? There'd just be way more downside potential there. And you can track that stock over the years. I mean, MU is a very roller coaster type stock. When things are good, they're really good, right? And this is like record really good. And when they're bad, ooh, it's no fun, man. It is no fun. So that's that, right? As far as stocks like Revolve, stocks like Cake, stocks like Elf, more like the small cap type stocks, right? Those ones will continue to run heavy. Those are seen as quality small caps. You got to understand the difference between low quality small caps and quality small caps, okay? Quality small caps are stocks like Revolve, stocks like Cake, stocks like Elf. Great business models, very proven, stronger balance sheets, those sorts of things, right? Stronger management teams. Then you have the weaker small caps. That would be stocks like a Fubo, for instance. Fubo would fit that sort of criteria, right? Riskier, more reward, but riskier. But people wouldn't look at Fubo and call it quality because they haven't proven profitability over the long term and those sorts of things, right? So there's a big divergence between quality small caps and what people see as riskier small caps. We're not in a risky small cap stock market right now. We could get there. Let's say hypothetically, we get back into another big bull run, right? At first, you'll see the quality small caps move. The stocks I'm showing you right now. The cake, and I mean, look at how much some of these stocks have rolled so far this year, right? So let's pull up cake on a year to date here, or a 1 month, a year to date, whatever. Okay. I want to get rid of AMD here, and I want to get rid of Nvidia. But look at cake so far. Let's also pull up a stock like Elf on a shelf. And then who was the other one we wanted to pull up here as a small cap? It was Revolve. And, we'll pull up another small cap or a stock that's kind of put in that small cap group that is seen as quality. And that's Celsius, right? So we'll pull up Celsius and, Revolve, sorry, RVLV. And you can take a peek at these babies, okay? So this is on a 1 month. Revolve's up 2%, Elf's up 13%, Cake's up almost 15%, Celsius up a shocking 28% in the past month. This is on a 5-day. Revolve's actually had a little bit of tougher troubles. That's probably because of the whole tariff threats, Europe, blah, blah, blah. Cake's up a little bit, Elf's up almost 6%, Celsius is up about 7.5%, right? So the moral of the story is here, I think the quality small caps will continue to move. Other stocks I think could do well are stocks like EL, stocks like Nike, that are, these are the turnaround plays, right? These are the value stocks, the turnaround plays. These are stocks that have been beaten down dogs, right? No one cared about them for the longest time. EL's showing a lot more momentum overall than Nike. So this is on a 1 month basis. Estee Lauder stock EL's now up 8% versus Nike's up 12% here recently. So, and we can compare that over the past month versus, let's say, let's pull up the Qs here and let's pull up the S&P 500 and see the divergence over this past month between these stocks. So this is a 1 month on the Qs. The Qs is actually down 0.7%. The S&P 500 is basically flat. And meanwhile, EL's up 8% and Nike's up 12%, right? So a major kind of divergence going on here recently. So though a stock like that could see momentum, American Express could definitely see momentum as well. Wynn could potentially see momentum. I think Wynn's a stock that could build as this year goes along, and here's why. With Wynn stock, there's a very exciting thing that's going to happen for them next year in 2027. And that is going to be their new property in the Middle East is going to open. We know that's a massive opportunity. We just don't know how massive. This could be an absolute game changer of a property. This could be what Marina Bay Sands was for LVS, for Las Vegas Sands. That could be what this property ends up being for Wynn. We don't want to get too hyped. We don't want to get too excited about it. But I can just tell you, as that property gets closer and closer to opening, right, there's going to be more hype and excitement that builds in a Wynn resort stock, winning resort. So just do keep that in mind. If China shows more stability and the Macau numbers continue to come in good, should be pretty good and fun times there, right? Honest is a stock that kind of gets thrown in with the risky small cap stocks. I don't think it should be. The balance sheet is superb with that stock. I mean, the balance sheet, Honest, is way better than most large cap companies. It's incredible. Their debt's basically non-existent. They're loaded on cash, especially if you compare their cash level versus their market cap, which is actually an important ratio. It's insane. So Honest gets disrespected and kind of thrown into low quality. It's not low quality. And look at their profitability now at the company, right? It's not low quality small cap. It gets thrown into this low quality. So just understand, if that one's going to make a run, we got to show a little more bullish activity overall. These quality small caps have to continue to roll, and then money will roll into stocks like Honest and stocks like Fubo and others, right? But I think Honest is way less risky than something like a Fubo, for instance, right? Fubo has more reward potential, right? PayPal is a beaten down dog. That just is its own thing, right? Adobe and Salesforce, listen, those stocks are going to be just fine. And I spoke about those stocks extensively, actually, in last night's video. Those stocks will be just fine. All they got to do is, as this year goes along, keep putting up great numbers, and everybody will shut up. It's as simple as that. Keep putting up. Google did it. They kept putting up great numbers. People were down Google, and the numbers just kept coming in. They're like, oh, I guess maybe everybody's not just going to leave Google search tomorrow and YouTube and all the different platforms, and I think Google's going to be okay. That's all these companies have to do. And show great growth in your AI-related products. Adobe's got to show great growth in their AI-related products and use cases, right? Salesforce, CRM, they got to show great use cases for Agentforce and that more and more customers are adopting Agentforce and actually using in the marketplace. Do that, put up great numbers. Everybody will shut up about those stocks and they'll just buy them. It's as simple as that. There's nothing complicated about those stocks. And all of a sudden, by the end of the year, you'll go into, from the beginning of this year, you'll look at those two stocks and be like, man, remember how weak Adobe was? Remember how weak Salesforce was at the first few months of the year? Look at how strong those stocks are. It's exactly how we exited last year in regards to Google. Google couldn't do anything right in regards to investor sentiment. It was so bad. It was so bad. And they just kept putting up their numbers. And then everybody said, you know what, Google's going to be all right, right? Gemini started taking some market share. Boom. Look what happened in the stock price. It exited the year one of the hottest stocks. And I think Google stock is the hottest Mag 7 by a mile, just to be quite frank. That's a stock I personally own. Like, let's pull up Google McDougal over this last bit of time versus the other Mag 7s. And you should see unbelievable divergence between Google McDougal and the other Mag 7s. So let's see, the other Mag 7s are Tesla, they are Meta, they are Amazon, they are Apple. Apple's been really weak. People are worried about memory chip pricing and what's going to happen there. They are Microsoft and Nvidia. Okay, so let's take a peek here. So, you can pull up almost anything you want in regards to this. It's incredible. It's absolutely incredible. So 6 months, look at how much Google's just killing it the past 6 months in regards to stock price versus everything Mag 7s. Past 6 months, Google 72%, Tesla 31%, Apple 16%, Nvidia 6%, Amazon's only 1.5%, Microsoft's down 13%, Meta's down 14% in the past 6 months. 3 month, Google McDougal's up 30%, Amazon's up 4%, Nvidia's up 1%, Tesla is down 3%, Apple's down 6%, Microsoft's down 13%, almost 14%, and Meta's down 16% in the past 3 months. 1 month, Google McDougal's up 6%, Amazon's up 1%, Nvidia's down, Microsoft's down 8.5%, Meta's down 8.5%, Apple's down over 9%, Tesla's down 12%. Unbelievable, right? The divergence between Google stock in the past 1 month, 3 months, 6 months versus these other guys. Incredible, right? And remember how weak that stock was at the beginning of last year. Man, people couldn't stop trashing it. So that's what I'm saying about Salesforce and Adobe. People can't stop trashing those stocks. They can't stop selling them right now. But just understand, this time next year could be a very different story. And all of a sudden, everybody will want in and be like, man, look at how strong Salesforce stock is. Look at how strong Adobe stock is. Tom Lee.
Back to the president and what's happening in the market. So framework to a deal, no force, all is well now for the Bulls?
Scott, I think so. I'd say on Monday morning before the open, I think investors were very concerned about Greenland and what's happened in Japan. And they thought of 2025 when it took 8 weeks for stocks to find their low, down 20%. So I think there was a lot of fear. So today's news really does do a lot to diffuse a lot of that anxiety. And I think it's wise to buy that dip.
Yeah, as part of this, of course, the president also saying no tariffs on Europe on February 1st. And that's what really upset the market. Are you still looking, though, Tom, as positive as you might sound for a bear market sometime around mid-year?
That's right, Scott. I think we have been pretty clear that we think that there is going to be a mid-year hiccup. It could be around policy or it could be around the new Fed being challenged. But that's coming from us markets being at a higher level. And I think one of the mistakes people make whenever they hear that commentary is they think it means to go to cash now. As you know, we've advised to stay invested and to buy the dip. But yes, there is a lot of good taking place in 2026, but we do have a lot that's already been priced in because of 3 good years of market gains.
What dip would you be buying specifically?
Well, for instance,
the interesting thing is a lot of these stocks are down significantly from their all-time highs, right? Like a lot of them are down significantly from their all-time highs. And I'm thinking about, even Apple, I think, is down 14% or whatever from their all-time highs. So it's just something to kind of keep in mind here. And looking on a 1 month basis, Apple alone's down 9%, Microsoft's down 8%. So, there's definitely a lot of attractively priced stocks. Like Meta's very attractively priced right now. PayPal's very attractively priced. Obviously, Honest is very attractively priced. AXP is very attractively priced right now. Nike's very attractively priced right now. EL still is as well. Elf is as well. Cake is as well. Salesforce, Adobe, stocks like that are very attractively priced. And a lot of these stocks are down significantly from their all-time highs. So, it's not like there's no opportunities. There's actually a lot of opportunities in this market. Now, could there always be more opportunities? Sure, but there's a lot of opportunity like right now.
I would be buying the dip on companies that have good earnings visibility or a structural reason to be long, because those that got sold yesterday, for instance, they're still the same great company. They were just 10% cheaper. I mean, to me, that's a stock I'd want to buy. The names I'd want to avoid are companies that are in the bullseye of White House policy, because we know last year the White House picked winners and losers. It created problems for healthcare and consulting companies. This year it's credit card issuers, institutional buyers of single-family homes, and it's some countries too. So I think that's the stocks to avoid. But I think fundamentally strong names, you still want to buy the dip.
I mean, it's complicated though. You say that you don't know who's in the so-called bullseye next. That's one of the problems.
100%. You're right, because if the White House decides that there's a company or a series of companies that are creating problems for Americans right now, whether it's credit card bills or electricity bills, there could be action. As you know, one of the potential, quote, risks is data centers and their consumption of electricity. So that is something to watch.
I mean, you're gonna say, don't buy the home builders, because what if the home builders, he doesn't like home builders building homes and charging the prices they're charging? I'm just saying it's a slippery slope to start going down, where, in your words, you have an administration picking winners and losers. It certainly complicates the picture a bit, doesn't it?
Home builder stocks just suck unless you trade them, right? And you know when to get in, when to get out. They suck. Here's why. Very cyclical industry, right? Housing can be very hot for a few years, very cold for another few years, and very so-so for a few years, right? It's not like it's an industry that your numbers can just keep going up and to the right? It's not that sort of business model. It's not like a Salesforce that every year their revenue goes up, right? Or an Amazon, every year their revenue goes up and they get more profitable and more cash flow, right? Home builders are not like that. They're much more of a roller coaster ride. When times are very great, here's the other issue. When times are great for these companies, they're making a fortune, so much cash flow pouring in. You know what they end up doing? Share buybacks. Guess when they're doing their share buybacks? When basically the stocks are at all-time highs because their business is on fire, right? So they usually go and spend all their money on share buybacks at the worst prices they could possibly be at, rather than just keep that money on the balance sheet, maybe earn 3 or 4% in treasuries at a particular time, wait for a downturn, right, in housing, your stock goes down a bunch, then come in with the big buybacks, right? Or, if things are really rough out there, then you could buy land for cheap. But the issue is CEOs are not just thinking about the next 5 to 10 years. The issue is a lot of these CEOs of these companies, they got to put up earnings per share now. So what happens is times are great. They're making a fortune. They try to buy back as many shares as feasible, right, without making it look too bad. So their earnings per share can go up in the short term. And they don't care that they just bought the stock at 100% premium versus where it was trading at a couple of years before that, because it's like we got to focus on those earnings per share right now. If they had a longer term view, I would probably be like, if I felt like there was a company that had a longer term view, like really thinking about the next decade, I would probably be more inclined to actually buy it. Like, let's say like a Steve Wynn was running one of these home builders, I might be much more inclined to be an investor. I'm like, oh, they really have a long-term mindset here. They're storing up cash for the next downturn, so then they can go buy shares for cheap when everybody's selling off the stock, right? They're going to be able to buy land for cheap. And heck, you can even buy other home builders for cheap when times get rough, right? Let's say you're just loading your balance sheet with cash and times get rough out there and other home builders are in trouble. You can go buy stressed assets for very cheap. So, I mean, but anyways, that's why home builders are,
Scott, I mean, every administration picks winners and losers. Tom Block, our policy strategist, has pointed out that's what Washington's habit is, that they tend to pick winners and losers. But we do have a White House that is quite ambitious. They've accomplished a lot, but they're trying to accomplish a lot. So you're right, that's the risk. And perhaps one of these is enough of a tipping point to cause a broader pullback in markets. I mean, that's another possibility for why we'd have a drawdown that feels like a bear market.
But you still feel as though whatever upset we see or feel is going to be reversed and we end up having a pretty strong year?
Yes. In 2025, that 20% decline did not lead to a recession. And as we pointed out, that since 1950, waterfall declines that are now followed by a recession, and particularly a VIX hitting 60, have been symmetric recoveries. So I think if we have a, 6-week drawdown, investors shouldn't sell because unless they're great at timing, we could recover all of that loss within 6 weeks. And we are expecting a really strong finish for the year. So, Tom, I think it's just...
When the VIX hit that 60 level, that 50, 60 level, I posted on X at that particular time. I said, never been in history where the VIX has gone this high, and it's not a great time to buy stocks. You got to buy, right? And Tom Lee actually reposted that on X at that particular time, and he actually started following me on X because, we definitely see eye to eye when it comes with that. You see that VIX go 30 plus, you better be buying. You see it go 40 plus, you better be buying heavy. You see that VIX go 50 plus, you better be going all in. As simple as that. Like you're in a freakish time period. You only get those opportunities once every few years. Like literally you could go 5-10 years between seeing the VIX going to the 40, 50, 60 level. It almost never happens. So when it does happen, you better pounce. You better pounce. You better pounce. And that's what we had back in that April time frame. And like, you had to be buying. Like, if you weren't, what the heck were you doing, man? So, keep that in mind.
Where does the Fed? Where does the Fed factor in to all of this? You heard the president with his obvious criticism of the current chair, Jay Powell, and some commentary on where the next chair may come from. How much does this matter to your outlook?
It's important, Scott. The Federal Reserve is the single most important entity in the world, and its independence is incredibly important because markets respect the Fed and they actually fear the Fed. So the independence matters. I think the process, and Steve Leisman made some good points, I think we're at odds increasing that it's a Fed that'll be respected because the multiple things taking place at the Fed now kind of limit how the White House can proceed to pick the new Fed chair. And actually, that's probably a good thing.
That 10-year, I was just looking at that 10-year, and I was just thinking, man, Trump wants to get that 10-year down. I wonder what his plan is to try to get it down. Because if you really want to get mortgage rates significantly lower from here, you got to get that 10-year down. If you get that 10-year down 100 basis points from here, then we could talk about bringing mortgage rates down to low 5s, maybe even high 4s, which that would be a complete game changer for the housing market. You start to enter the 5s, I think you can start to thaw out the housing market and get things moving a little bit. But if you take it down to the low 5s or potentially even in the 4s, boom, that's the number, man. That's when you could get housing booming again. And when I say housing booming again, I'm talking about people moving, right? People have been living the same place they've been living for years now at this point in time because mortgage rates, right? You take mortgage rates from 3 to 7, that's going to completely freeze the housing market. And that's where we've been for the last several years now at this point in time. But you want to start thawing it out, take it into the 5s. You want to completely thaw it out, take it mortgage rates in the 4s. Then we're talking, but you got to get that 10-year down. You got to get it down.
I really think it's an A-block story. 52-week low as we look at shares down more than 4.5% today. So you sold half of your position. Why now? presumably you're going to tell me because the stock is in no man's land until we figure out what happens with the deal, which was the case before the numbers hit.
So when something, and I thought about this quite a bit, obviously I missed the point to sell it, which is when they first got involved in this, right? And some others on the desk did it shortly thereafter.
Josh, I think, sold 85% of it the day the deal was, at least the offer, the day the initial offer was announced.
So I think it's important to be very open-minded as an investor. Now, I can either say I missed it, or I can say, okay, here's what the market's presenting to me now. What do I want to do now? Do I want to continue to bemoan the fact that I made a mistake not selling it later? Or do I say, hey, I want to raise some cash because this stock maybe bounces to 90, but it's going to be stuck there for a while. So I'd rather raise cash now and keep that when I see a real market dump. So that's why I did. I did half of it. Maybe I'll do the other half. I don't know. But I still like it on.
Market dump? What if we don't get a market dump, sir? Like, this is why, like, if you need any more proof why you just stay focused on long-term investing, like, these videos like this are a perfect example. Like, Netflix stock is down significantly from its all-time high. Netflix is factually a great company. None of us can debate that, right? One of the best companies in the world, right? I told you when that deal came out, I don't like it. It's going to mean Netflix stock's going to be in, basically kind of a dog for a while, right? And that's exactly what we're seeing playing out. But with that being said, if I was a shareholder in Netflix to sell out now, 83, and the stock's down significantly, and it's a great company, like, that's just crazy to me. Like, it just doesn't make any sense. You can choose not to buy the stock. That's fair play. But to sell it if you own it now, a great company down, I don't know how much it's down from all-time highs. Might be down 30%, 40%. Like, no, probably not 40%, but 30% or something like that. And then to try to play the game of, well, I want to raise capital and, in case the market really dumps. Dude, we could go back into a bull market now. You know what I mean? Like, what are we doing? Like, we go on a big bull run between now and summer. Let's say that hypothetically happens. We don't have any drama like we had last year. Remember last year we had a bunch of drama from February into April, right? Let's say this year is just smooth sailing. There's really no drama from now all the way to summer. And earnings are great. Economic numbers look good. Inflation stays at bay. And then hype starts to build and excitement starts to build about Jerome Powell leaving and somebody getting into that Fed chair seat who's going to be lowering rates more significantly, right? Dude, next thing you know, you're in a big bull market. And the Qs goes up 10, 15% between now and summer. What if that happens? That's a possibility. Should be something you're considering. Not just banking that, you need to sell your Netflix right now in case the market dumps. The market might not dump. Market might go straight up. And then you're stuck holding a bunch of cash. And your Netflix stock went to 95 or 100 or something like that, right? And you missed a bunch of opportunities because you're holding cash in case the market dumps. Like, what are we doing, man? Gosh, stressful. That's got to be so stressful to try to be playing these games of in and out, in and out, in and out. Come on, man. Just focus on long-term
basis. And I'm not happy they're buying it. As I said before, I'd rather have Paramount buy it and then get crushed under the debt load. And that way, Netflix will be able to buy content cheaper. But
do you think Netflix wins if it loses this particular deal?
Yeah, I think they win if they win, and they win if they lose. They don't win by as great a margin if they buy this. I just don't know why they need it. You're paying $100 billion, close to $100 billion for an asset where you can put that directly into content.
Agree.
Right? Instead of, and that's 5 years worth of content, according to what they're saying, of $20 billion a year. And be way ahead of the game.
I agree.
So, and then take out a competitor.
Assuming you can develop the kind of content that they think they're able to acquire through the transaction.
Right, which I have a record of. Right?
Netflix has a YouTube problem, right? They have to focus on developing original content in order to compete. The reason they got unseated by YouTube in the first place is because the appetite has shifted to original content. So 25% of all viewership of YouTube now is on actual TV sets. That's a problem for Netflix, and that's the problem they have to focus on.
Yeah, what Netflix should really be spending a lot of money on, in my personal opinion, is sports rights. Sports rights. Because Netflix is really focused on building their ad business right now. And the big ad money, you get that from sports. Because it's live. People, people just binge watch shows, right, with no ads and anything like that. Sports is live. People put on their big screen TV and watch the football game, the soccer game, basketball game, baseball, hockey, whatever, okay? They got it up there. They're watching it live, commercial break, boom, 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 bunch of commercials play. Okay, back to the game, bunch of commercials play. That's how people watch sports. And so, like, you can get a great ROI on that and make Netflix a much stickier product overall. I think that's where they should be spending their money. That's where they'll get the best ROI. But hey, they want to go spend $90 billion. That's their decision on, another company. Alrighty, guys, I appreciate you for joining me. As always, thanks so much for being here. For those of you that are looking to take your investing up to a much higher level, get in a phenomenal group. That will be the pinned comment down there to apply. Join my private stock group. Much love and have a great day.